Hey, this is Seth Peak with Peak Realty here again with my buddy Harry Bennett at Equity Reach
Yes.
Mortgage.
Thank you, man. Thanks for having me.
How's your day going?
Fantastic, man. Excited to talk about these manufactured homes here.
Yeah, so we've been having a couple clients looking to buy a manufactured home, and we'd just like to jump on here and chat about it and how do we fund one of those here. I know there's different types. There's inside of a park where you own the space, inside of the park where you don't own the space,
Mm-hmm.
where you're renting, and then there's manufactured homes that's on land. It could be on a foundation,
Yeah,
on
absolutely.
post and pier, or however they set it up.
Right. Yeah,
So
yeah. So you're dead spot on. I mean, you could be in a park. You could also be outside of a park. And
mhm,
just because it's outside of a park doesn't mean it's going to be acceptable for traditional Fannie and Freddie financing, right?
mhm.
So it has to be outside of a park where you do own the land, and it has to have required permanent foundation on there, which is a 433A recording on the title to show that it's been permanently affixed to get their standard financing.
So who puts that on the title? The builder and the building permit? Whoever.
That's a good question, but I want to say it gets recorded into county, So I mean, engineer comes out and the construction worker does their job into fixing it to the permanent foundation. It gets recorded ultimately into the county. That lets everybody know, hey, this manufactured home is
Mhm,
recorded with actual. It's now treated as real estate. That's the thing, is that one's in a park. Technically, you own the trailer, you own the
mhm,
manufactured home, but you don't own the space, right? So
mhm.
those are chattel loans. Those are a lot different. We don't do those, but there's some banks that do.
That's like a personal property loan, right?
Yeah, it's like a
Basically.
personal property. Yeah, exactly. It's treated as personal property. I think those actually go through the Department of Motor Vehicles to get registered to you. Versus this way, when you're outside of a park and it's permanent foundation and it's taxed and treated and assessed as real estate, then it's,
Right.
yeah.
So the goes to the DMV because it has the VIN. Usually, like if you're looking at this and you're not sure, but most parks are going to have this. Most parks you rent the space, right?
Yeah,
And I know in
absolutely.
slocounty it could be anywhere from $500 to $1,100. I mean,
Yeah.
depending on if it's downtown Pismo, if it's outside Morro Bay,
Sometimes for
if you're in
more.
Paso Robles, sometimes it's more than
Yeah.
1,100.
Yeah.
So it's important to know that for sure. Give me an example of like how it would be different if it's permanently fixed on a foundation on some land, and it can be a conventional loan.
Hmm.
Is the process going to be different for the home buyer
Yeah.
to qualify for it?
It will be compared to like a regular home, not on a qualifying standpoint. Some loan programs with manufactured homes, they do have a debt to income ratio
Mm,
limitations, right? They consider a manufactured home to be more of a risky investment, right? More of a it's like having a condo. That's a layer of risk. Standard, single family built homes, least amount of risk, right?
hmm.
So we
Right.
are in a risk based business. That's another piece of risk. So they sometimes, depending on what program you go through, if it's a down payment assistance program,
Mhm.
you may see some limitations on how much you can go up to your debt to income.
But if it was a higher, what ways, if you like a higher down payment would weigh heavier than like say a lower ratio, debt to income ratio?
Some programs that they're just going to say, hey, this is a debt to income ratio, it is what it is, and they're going to
Yeah.
stop at a 45.
Okay.
And there's just really no way around that.
Mhm.
Now that would be like a down payment assistance thing, or if you're outside of that and you're just trying to do a conventional loan, 5% down, right, on that
Mhm.
manufactured home, then that's fine. You can probably go up to that 50. You can go right up to the 50 mark. Yeah. And FHA approves them too.
And this might be a simple question to us, but maybe someone listening here, is interest rates for loan products for manufactured homes on a fixed foundation, like we're talking about on
Yeah.
property, is it higher, lower, or the same as a stick frame
Oh,
house?
yeah. I'm so glad you asked that, because it could be a little bit of a shock if you're looking at it and then you're looking at a family home and then you go and look at this, you're like, why is my rate so much different? Yes, there is a difference in the rates
Mhm.
on manufactured homes. Again, going back to risk-based business, that is more of a riskier product. So when you're looking at it, the rates, they do have a little bit higher rate on those manufactured homes versus a family, single family built. So yeah, there is a little bit of a premium on it. It's not like anything like you're going to be 3 or 4% over, but there is, there's a premium, maybe about 0.5% or so.
Yeah, but generally a manufactured home is going to be less overall cost. So it might, if you're penciling in how much you can budget for it, you might be able to afford a little bit more home than a stick frame home.
That's a great point. Yeah. I mean, I live in a manufactured home, and it's not everything it's cracked up to be, and it's not everything that it's that people say the cons are, so it's all subjective. And I think you made a great point. It's what can you afford at the end of the day.
Well, I know that we have a dealer up here in Templeton, Paso Robles, Templeton kind of border, and they sell, and you can basically get a manufactured home like completely customized to however you want the layout to be. They have lots of different styles, colonial versus craftsman. So if you were going to buy even to buy one to build, with a conventional loan, can you buy a manufactured home brand new and get a loan and to put it on the property, or do you have to get a construction loan and then roll it into a conventional?
Yeah, that's a pretty complex one. I would imagine that the dealer might have some very specific financing for those, but certainly you can do a construction loan and put that on there. Conventional, I've never done it, so I won't really comment too much on it. I've never really seen that scenario. Typically the place is already there. So but I would imagine a construction loan would be perfect for that.
Well, awesome. This has been awesome. It's been great. Great chatting with you. It's a topic that comes up quite often around here. There's we have a handful of manufactured home parks in North County and South County. Yeah. And a lot of our first-time home buyers are kind of considering that option. It's easier to get the foot in the door nowadays with the median home price being a little bit higher than past years.
Let me ask you, Seth, what's the, I mean, do you for the resale value on those in a park, I mean, are they holding pretty strong? Do they have an appreciation, or is it all over the place?
It really depends on the park.
Okay.
I mean, it can be, if you're by, like I said, there's Morro Bay, Pismo Beach, there's a lot of manufactured homes parks in areas that are 55 and older. I know there's one here in Paso Robles, for example, Quail Run, which is a very sought after manufactured home park for 55 and older. And it definitely holds its value. Some of the homes in there, $400,000 to $600,000 in that park. But that's gonna be different than like what we're talking about with the conventional loan. But up here in North County specifically, a lot of people have manufactured homes on property that they own on fixed foundations. And it's really the land that holds the value. And it doesn't go backwards. I'll put it that way. It's not going to exponentially go, appreciate like in the past few years, like we've seen with stick frame, like single family homes on property around here, but it definitely holds its value. It doesn't go backwards.
Yeah. And one thing to consider too, if you're buying a manufactured home with land outside of a park, right, where it could qualify for traditional financing. So it's going to be has to be built after June 15th, 1976 and newer, right? And then the other thing to consider, which I didn't know before I purchased mine, was that if you're planning on doing a cash out refinance, a lot of people, they go, okay, I have a lot of equity, I want to access my equity. Right. You will be surprised that a lot of investors will not go up to the typical 80% loan to value, right? They will stop at a 60 or a 75% loan to value, and they won't do a 30-year, they'll do a 20-year. So just check into those things before, if you're planning on accessing equity. There's also other ways of HELOCs. You can access the equity out of a HELOC, which could allow you to go up to 80% depending on the investor. Wow. Yeah. A couple of little things to think about.
Yeah. Well, lots to think about. Check out this video. If you enjoy this video, send us a comment. We'd be happy to connect you with Harry or myself if you have any more questions. And we look forward to seeing you on the next one, Harry.
See ya. Take care.
See ya.